I think the financial markets are forecasting that the Fed, not just the Fed, but all central banks, ECB, Bank of England, Bank of Japan. Well, Bank of Japan, they've been doing it forever. They're going to have to loosen policy. And we've seen that bond yields have come off substantially in the last month. And that helps gold because real returns on bonds are going to come down relative when you take account of inflation. And the other thing about the reason why I think the dollar and the euro and the yen and the pound are falling versus gold is that governments are still borrowing and spending massively.
On Monday, gold prices set another record consecutively for 2 days as spot prices reached the $2,100 mark, continuing the worldwide demand for gold. The momentum in gold is driven by market speculations of a possible interest rate reduction as soon as March. Market expectations, as indicated by the CME FedWatch tool, now suggest over a 50% likelihood of an interest rate decrease in the first quarter of 2024. Noted analyst Mario Innecco identifies a significant shift in gold's trend, pointing to a pattern similar to 2011, which he likens to a teacup emerging since 2020. He attributes this shift to central banks, particularly the Federal Reserve, moving away from a prolonged phase of low interest rates and extensive quantitative easing. This shift, coupled with a rising consumer price index and global political unrest, has caused gold prices to plateau, fluctuating around $1,800, below the $2,000 mark. Bolstered by ongoing conflicts like the Israeli-Palestinian strife, gold prices have surged over 2 successive months, underlining its status as a safe haven asset. Anticipations of rate reductions have also contributed to its rising value. Gold's performance typically excels during times of economic and geopolitical instability, given its established role as a reliable store of value. In contrast to the limitless printing of fiat currencies, which leads to devaluation and inflation, gold has consistently outperformed these currencies in the last 2 decades, becoming an asset of choice. Central banks are increasingly investing in gold, seeking its stability against currency devaluation. The World Gold Council's recent survey indicates that 24% of central banks plan to increase their gold reserves in the next year, demonstrating growing doubts about the US dollar's status as a reserve currency. Mario Innecco used gold as a check on the power of central banks and influential figures, limiting their influence over currency valuation. Gold acts as a protective barrier against inflation, safeguarding people's savings from the erosion of value due to currency devaluation. We will show clips from Mario Innecco's analysis.
So why do I think gold is breaking out now? We've had, since 2020, we formed a top. We formed this handle in the huge teacup that started in 2011, and even the handle looks like a teacup itself. Well, I think it's been because of the Fed and other central banks finally tightening policy after a couple of decades of very low interest rates, negative real interest rates, a lot of QE. So they stopped that, and then they started tightening, and they've tightened more than most people imagined, even me. I didn't think they'd get that much above 2 or 3%. But the thing is that the CPI, which is what people call erroneously, not in my opinion, but it is erroneous to call CPI inflation, that was taking off. It wasn't transitory as they thought. And then you had other things helping prices higher, like geopolitical crises, which I won't go over here. And that's why gold, I think, stopped under 2000. It kind of held around 1800. Yes, we dropped to even above 1600 in the meantime. But what's happening now is I think the financial markets are forecasting that the Fed, not just the Fed, but all central banks, ECB, Bank of England, Bank of Japan. Well, Bank of Japan, they've been doing it forever. They're going to have to loosen policy. And we've seen that bond yields have come off substantially in the last month. And that helps gold because real returns on bonds are going to come down relative when you take account of inflation. And I think a lot of investors don't buy these CPI numbers. A lot of people hopefully are learning about what real inflation is. And we're going to look at some charts as well about monetary aggregates in the stock market and why the Fed and other central banks, they will have to accommodate, or else, things could get very precarious in the financial sector and the whole economy. So enough of me talking. Let's look at some charts of gold and silver. What about silver? Well, silver is done well as well. It has a lot more to catch up, but we'll look at silver maybe tomorrow during the live stream. But the first chart I wanted to show you is an interesting one. You can access this website, of course, fxtop.com, and you can go under here, historical rates, and you put the United States dollar first, and then you put the gram of gold second. So I chose the 1st of January 1971. I guess I could have picked 15th of August, but it's such a long time ago that it doesn't really matter, a few months. But what it's showing here, this chart, is that back in 1971, with $1, you could buy, let's see, around 0.829 grams of gold, right? And now, as of yesterday, you could only buy 0.0153 grams. So, yeah, this just goes to show that it's the fiat currency that is dropping. Yes, it feels like gold is going up in price. And it's one of the reasons why I've held on to gold and silver. It's the easiest, I would say, and the most difficult decision at the same time to hold it for a long time. Why is it the easiest? Well, because from all the research that I've done, all the reading that I've done about history and money, there's no exception to the rule that all fiat currencies end up being worth zero. Just like Voltaire said, paper money reverts to its intrinsic value always, and that's zero. But the tough part about holding gold and silver in a fiat currency system is the psychological war that the central bankers and the bankers wage, because I think it was Paul Volcker actually once said in a meeting with someone, I heard this years ago, I'm not sure, I can find it online, but he said that gold is the enemy of the central bankers, and he's right. And gold is also the enemy of the state and statists, because fiat currency allows them to steal your hard-earned efforts, your labor, your ideas, your production, because they can inflate that currency away. They get the currency first, you get it last. Well, gold protects you against inflation, against theft of your efforts. Of course, confiscation is a different story.
Since the onset of 2020, the United States has experienced a marked and sustained increase in inflation. This trend peaked in November 2021 at approximately 6.8% and soared to a 40-year high of 9.1% by June 2022. Mario Innecco has noted this significant inflationary trend, acknowledging a minor reduction later, but stressing that the current inflation rate rates are still much higher than in previous years. He questions the effectiveness of current strategies to combat inflation, such as the rate hike discussions by entities like JP Morgan, considering them insufficient. Mario relies on the M2 money supply, which includes M1 and certain short-term deposits, to demonstrate that although the rise in M2 is not as drastic as in M1, it still significantly exceeds the levels seen before 2020. This distinction highlights the ongoing increase in monetary supply, signaling its continuous effect on the economy. Furthermore, Mario believes that currency devaluation will persist, even if authorities attempt to lower bond yields to influence economic factors. Gold continues to serve as an unwavering standard for gauging the true value of currencies. Let's return to the interview for further insights.
So, as you can see, we've had massive inflation since January 2020 or March 2020. Yes, it has deflated, but it's still way above here, and I don't think they can deflate anymore, even though Jay Powell yesterday said, oh, we will raise rates again. But I don't think they're doing enough. If they were doing enough, gold would not be making new highs. So M2, of course, includes M1 plus some short-term deposits. Unfortunately, the Fed doesn't publish M3 anymore, but it's the same story. It hasn't really increased as much as M1, I guess, but it's still way above where we were there before March 2020. As you can see, there's a little gray line there marking a recession. Yeah, it looks like it's flattening out right now. Let's look at it in 1 year terms, or let's change this here. Yeah, as you can see, they started, it's flattening out right now. And as you can see, I've put here a chart of the NASDAQ composite. And you can see how important it is. Let's shorten the time frame. You can see how important it is. Like here, for example, when the NASDAQ was falling quite sharply, they started ramping up the money supply, right? And I think they're going to do it again. I mean, this is only till October, this NASDAQ chart, so it's come back up. So that's the other reason I think the markets are doing what they're doing, because the markets, of course, are addicted to credit, to easy money. And in a fiat currency system, you got to keep expanding the debt. You got to keep borrowing, or else everything collapses. And the other thing about the reason why I think the dollar and the euro and the yen and the pound are falling versus gold is that governments are still borrowing and spending massively, especially in the US, but also here in the UK, even in Germany. And that's inflation itself, all the fiscal spending. And people are realizing that with interest rates not really being in a good place. And what do I mean by that? Well, I think the bull market in bonds is finished. Yes, we have had a rally, but I think that's the other thing that gold is telling us, that to expect more currency debasement. And yes, they might be able to manipulate bonds lower, like bond yields lower and prices higher, like they've done in Japan. But ultimately, gold will tell the truth, just like it's told the truth of the yen. After all, JGB yields are really low, but the currency there is becoming, trashier and trashier by the day. And you just saw the chart of the price of gold in Japanese yen.
Analysts predict that gold prices are set to achieve new highs next year, potentially maintaining levels above $2,000. This forecast is based on factors like geopolitical instability, a projected weaker US dollar, and possible reductions in interest rates. Subscribe to the channel for more trendy financial news updates, and we will see you in the next one.